Welcome to this explainer. Okay, so if you've ever turned on the evening news and heard an anchor enthusiastically shouting, "The S&P 500 hit a new high today," or, frantically warning about a massive drop, and you just found yourself wondering what on earth they are actually talking about, well, you are in exactly the right place. Today, we're focusing on demystifying all that market jargon. We're going to cut right through the noise and look at the actual mechanics of investing that so many financial talking heads just assume you already know.
I want to ask you this directly. What exactly is the S&P 500? I mean, everyone references it, right? It's scrolling on that little ticker at the bottom of the screen. It's in the newspaper, but very few beginners actually understand what it is. Is it a specific company? Is it a trading app? Or is it just some secret financial language designed to keep everyday people out of the loop?
Okay, let's dive into this. Here is our quick roadmap for today's explainer. 1. What is an index? 2. Meet the S&P 500. 3. Inside the S&P 500. 4. What are index funds? And 5. The pros and cons. All right, Section 1. What is an index? Building the basket.
So technically speaking, a price index is a normalized average measuring relative price changes for a specific class of goods, services, or stocks. But let's ditch the academic jargon for a second. Think of an index like a scorecard for a sports league. If you want to know how the whole league is doing, you don't just look at one single team, right? You look at the entire league. Or, better yet, think of it like a giant fruit basket. Instead of just tracking the price of one single apple, you're tracking the total value of a basket filled with apples, bananas, and oranges. If the overall price of the fruit in that basket goes up, the index goes up. Simple as that.
To really grasp this, let's look at a direct comparison. Buying a single stock literally means buying a piece of one specific company. If they do well, you do great. But if they go bankrupt, well, you lose it all. It's high risk, high reward. A market index, on the other hand, tracks a massive basket of many companies. This is absolutely crucial because it helps you avoid the total chaos of trying to track the daily news and performance of thousands of individual companies. It's basically a shortcut to measure the overall performance of the market at a single glance.
Now, here's a fun fact. You might think this is some modern Wall Street invention, but it actually dates back centuries. Get this. In 1351, the Statute of Laborers used wage levels as a proxy for a basket of goods. By 1675, a guy named Rice Vaughan was using those old statutes to analyze English inflation. And then, brilliantly, in 1707, an Englishman named William Fleetwood developed what is likely the very first true price index. And why did he do it? Because an Oxford student was about to lose his fellowship due to a strict 15th century income cap, and Fleetwood wanted to prove how the value of money had changed over 260 years. So, from 15th century Oxford to modern trading floors, the core idea is exactly the same. Moving on to Section 2, Meet the S&P 500, the giant of the U.S. market.
Just take a second and look at this mind-blowing number. $61.1 trillion. As of the end of 2025, that is the aggregate market capitalization of the S&P 500. This single index tracks 500 of the leading U.S. public companies, and to put that scale into perspective, it represents approximately 80% of the total market capitalization of U.S. public equities. The sheer size and gravity of what this scorecard tracks is just staggering. It truly is the definitive giant of the U.S. market.
But how does a company actually get into this exclusive $61 trillion club? Well, it's definitely not automatic. A committee uses really strict rules to ensure only the most significant players make the cut. First, the company must be U.S.-based. Second, it needs a market cap of at least $22.7 billion. Third, it has to actually be profitable, meaning it shows positive net income in recent quarters. And finally, it must have high market liquidity, which just means its shares are easily bought and sold. So yeah, it's a highly curated basket.
Section 3, Inside the S&P 500. Let's peek inside the basket.
Now, what's really interesting about this slide is how the composition of the index brilliantly illustrates the current landscape of the U.S. economy. While the index does give a broad picture, it's definitely not evenly split. It is heavily weighted toward information technology, which takes up over 34% of the index. Financials come in second at around 13%, followed by communication services, consumer discretionary, and healthcare. So essentially, when the S&P 500 moves, tech is very often the main engine driving that movement.
And that brings us to a super vital concept. The S&P 500 is what we call capitalization weighted. That just means bigger companies have a much larger mathematical influence on the index than the smaller ones do. Look at the top players here. NVIDIA alone makes up over 7% of the entire index. Alphabet and Apple follow closely right behind it. In fact, the 10 largest companies account for almost 40% of the entire index's weight. So, when these tech titans have a really good or really bad day, they literally pull the whole 500-company basket along with them.
Section 4. What are index funds? Putting the index to work.
Okay, so we understand the theory, but how does an everyday investor actually use this information? I mean, you can't exactly call up Wall Street and say, "Hey, I'd like to buy one S&P 500, please." Here's the definition. An index fund is a mutual fund or an exchange-traded fund, an ETF, that simply aims to mimic the performance of a target index. Because you can't buy an index directly, financial institutions create funds that pool money from thousands of investors to buy the exact stocks in the exact proportions of the index. They do all the heavy lifting, saving you the impossible hassle and cost of buying shares in 500 individual stocks yourself.
And honestly, investing in one is remarkably straightforward. As outlined by Fidelity, it's really just 4 simple steps. First, you open a brokerage or retirement account. Second, transfer some cash into it. Third, search for an index fund, like an S&P 500 ETF. And fourth, buy the shares. What's absolutely incredible is that nowadays you can often buy fractional shares. That means you can start owning a tiny sliver of the top 500 companies in America for as little as $1. No way it used to be that easy.
Section 5. The pros and cons. Is it right for you?
So the crucial point is, does this passive investing strategy actually make sense for you? Let's impartially look at the advantages first. The biggest one for sure is immediate diversification. You're spreading your risk across 500 companies instantly. Next, because the fund just blindly follows a list, the management fees are incredibly low. You might pay as little as 0.015% in fees, compared to 1% or more for a manager who's actively trying to pick stocks. It also drastically reduces human emotional bias. There is no panicked manager selling off your assets during a bad week. And finally, because they don't buy and sell rapidly, they're highly tax efficient. This whole package acts as a really powerful, low-cost safety net for beginners. But, we've got to look at the disadvantages neutrally too. By definition, an index fund gives you average market returns, so you are never going to outsmart or beat the market. Furthermore, there is zero downside protection. If the market crashes 30%, your fund crashes 30%. There's no manager there to hit the brakes and move your money to safety. You also have absolutely zero control over the individual holdings. If you dislike a specific company's business practices, well, too bad, it's in the basket. And finally, sometimes funds experience slight tracking errors where their performance temporarily drifts from the actual index. Despite those downsides, there is a massive reason legendary investors constantly recommend index funds to everyday people. The S&P 500 has an average return of over 10% per year before inflation and taxes since it was introduced in 1957. Now, while we always have to remember the golden rule in finance, past performance does not guarantee future results, this historical context shows exactly why betting on the broad growth of the economy has historically been a very, very solid strategy. And that brings us to the end of our analysis. We've seen how indexes evolved from tracking medieval wages all the way to measuring a $61 trillion market, and how index funds allow literally anyone to buy a slice of that pie. So I'll leave you with this provocative question to think about for your own financial journey. Armed with this knowledge, will you spend your time trying to actively beat the market, or will you choose to simply own it? Thank you so much for learning with me today. I really hope this structured look at the S&P 500 has cleared up the jargon and empowered you to make informed decisions going forward.